Over the past year, something unusual has been forming around the future of the American economy. On the surface, things appear relatively stable. Growth continues, businesses are operating, and unemployment has remained manageable. But beneath this calm surface, there is a deeper tension building, an energetic pressure that many analysts, economists, and even intuitive observers can feel. Inflation, although no longer at the painful peaks of previous years, still lingers in the background of everyday life. Millions of families continue to feel its effects when they go to the grocery store, fill their gas tanks, or pay their monthly bills. Now, a bold new economic vision is being pushed forward by the Trump administration. And it is not a small adjustment, it is a massive gamble. The administration is aiming for something extraordinary, a potential 6% growth rate for the US economy. To understand how significant that is, we need to put it into context. For decades, the American economy has typically grown at around 2% to 3% per year. That level of growth is considered healthy and sustainable for a mature economy like the United States. But 6% growth would be something completely different. It would represent one of the fastest expansions in modern American history. Supporters believe this could launch a new era of prosperity. An economic surge strong enough to transform industries, create millions of jobs, and dramatically increase national wealth. But critics are deeply concerned. They warn that pushing the economy to grow this quickly could destabilize the entire system. Some economists believe this strategy could trigger dangerous inflation, financial instability, or even a severe economic correction. And when we step back and look at the broader picture, something interesting appears. There are moments in history where economic cycles accelerate rapidly, almost as if a larger collective momentum is pushing events forward. When I tune into the broader energy surrounding the global economy and the United States specifically in 2026, I sense a period of strong expansion mixed with significant volatility. Not a simple upward trend, but a year of testing, a year where big decisions could create powerful opportunities, but also unexpected consequences. So the question becomes, are we about to witness one of the strongest economic expansions in decades? Or is the United States entering a period where rapid growth could bring hidden risks to the surface? In this analysis, we will explore the policies driving this economic gamble, the arguments supporting it, the warnings coming from economists, and the three possible economic timelines that could unfold in 2026. Because what happens next will not just affect markets or government budgets, it will affect the everyday lives of millions of Americans. To understand how ambitious this economic vision really is, we need to look at where the idea of 6% growth is coming from. In early 2026, speaking during international economic discussions in Davos, Commerce Secretary Howard Lutnick made a striking prediction. He suggested that the US economy could experience growth above 5% in the first quarter and potentially reach 6% growth by the end of the year. For economists, that number immediately raised eyebrows because sustaining growth at that level would require enormous economic momentum. But for the Trump administration, this prediction is not just a forecast, it is a goal, a signal of the kind of economic acceleration they believe is possible if their policies fully take effect. So how exactly do they plan to achieve this? The strategy can be understood through three major pillars. 1. Large tax cuts. The first pillar is a new wave of tax reductions designed to inject more money directly into the economy. One of the most significant policies is the legislation known as the One Big Beautiful Bill Act, often referred to as OBBBA. Signed into law on July 4, 2025, this bill extended and expanded several tax policies originally introduced during Trump's first administration. Key components include making many individual tax cuts permanent, introducing temporary deductions for certain types of income, like tips and overtime, maintaining the $2,000 child tax credit, while temporarily increasing it to $2,200. The idea behind these tax cuts is straightforward. If households keep more of their income, they are more likely to spend that money on goods, services, and investments. And when millions of consumers increase their spending, businesses respond by expanding production, hiring more workers, and increasing economic activity. This creates what economists call a demand-driven expansion. 2. Deregulation. The second pillar of the plan is deregulation. The administration has argued that excessive regulation slows down innovation, increases business costs, and discourages investment. Their strategy is to remove or simplify many regulatory requirements across multiple industries, particularly in energy, finance, and manufacturing. The belief is that by reducing bureaucratic barriers, companies will find it easier to expand operations, open new facilities, develop new technologies, hire additional workers. In theory, this would stimulate growth from the supply side of the economy, increasing productivity and economic output. To help drive this effort, a new agency called the Department of Government Efficiency, often referred to as DOGE, was created to identify areas where federal spending and regulations could be reduced. 3. Pressure on the Federal Reserve. The third pillar of the strategy involves monetary policy. The Federal Reserve controls interest rates and plays a central role in managing inflation and economic growth. However, the Trump administration has openly criticized the Federal Reserve for maintaining relatively cautious interest rate policies. Officials have argued that lower interest rates would encourage borrowing, business investment, home construction, consumer spending. There has also been speculation that Trump may eventually appoint a Federal Reserve chair who is more supportive of aggressive economic growth policies. If interest rates were reduced while tax cuts and deregulation were simultaneously implemented, the result could be a powerful combination of economic stimulus. Taken together, these three elements form the foundation of the 6% growth strategy. It is a bold approach, one that deliberately accepts higher risk in exchange for the possibility of rapid economic expansion. But whether the economy can actually sustain this level of acceleration remains one of the biggest questions heading into 2026. The case for the boom. Could a new economic expansion begin? For supporters of this economic strategy, the concerns coming from traditional economists sound overly cautious. In their view, the American economy has spent years operating below its true potential. They argue that excessive regulation, high taxes, and restrictive monetary policy have kept growth artificially limited. From this perspective, the policies now being proposed are not reckless at all. They are simply removing the obstacles that have held the economy back for decades. Supporters believe that once these barriers are lifted, the natural dynamism of the American economy could re-emerge. And when they point to evidence supporting their optimism, they often refer to several recent economic indicators. One of the most significant was the 4.4% annualized GDP growth recorded in the third quarter of 2025. For many within the administration, this was not seen as a temporary spike. Instead, they interpreted it as an early signal of what the economy might be capable of if pro-growth policies continue to expand. There were also moments when forecasting tools like the Atlanta Federal Reserve's GDP Now model suggested the economy might reach even higher levels of growth. At one point, projections briefly estimated fourth quarter growth could reach 5.4%. Now, the final official estimate turned out to be much lower, landing closer to 1.4%, which reminded economists how volatile economic forecasting can be. But inside the administration, the focus remained on the possibility that stronger growth could return if consumer demand and business investment both accelerate at the same time. And that is where the core of the strategy lies. The administration believes that tax relief will increase consumer spending, while deregulation and lower borrowing costs will encourage businesses to expand. When both forces move together, they can sometimes create powerful economic momentum. Imagine, for example, a mid-sized manufacturing company located somewhere in the American Midwest. For years, the owners may have considered expanding their operations, purchasing new machinery, increasing production capacity, or opening an additional facility. But uncertainty about taxes, regulations, and long-term economic conditions may have caused them to delay those plans. Now imagine the situation changing. Corporate tax burdens are reduced, regulatory requirements become simpler, borrowing costs potentially decline if interest rates fall. Suddenly, the expansion becomes financially attractive. The company decides to move forward. New equipment is purchased. Construction begins on an additional production line. Within a year, the company hires dozens of new workers. Multiply this process across thousands of businesses nationwide, and the result could be a significant increase in economic output. This is the vision supporters of the plan see unfolding. They also point to labor market dynamics. When economic growth accelerates, the demand for workers tends to increase. Businesses compete for talent. Wages begin to rise. During parts of 2025, for example, weekly wages were increasing at roughly 4% annually. Although some financial institutions later observed that wage growth slowed closer to 3.5%, supporters argue that stronger economic expansion could reignite upward pressure on wages. There is also another factor that could amplify economic momentum: the wealth effect. When stock markets rise and retirement accounts grow in value, households tend to feel more financially secure. That sense of financial confidence often leads to increased spending. Consumers buy cars, renovate homes, travel more frequently, and invest in new opportunities. All of these behaviors reinforce economic expansion. In the most optimistic scenario, the economy enters a powerful growth cycle. Consumer spending increases, business investment expands, job creation accelerates, wages rise, and the entire system begins reinforcing itself in a positive feedback loop. This is the future supporters envision. But when we step back and observe the broader economic landscape, both through traditional analysis and through intuitive interpretation of economic cycles, another possibility emerges. Because rapid expansion does not always lead to long-term prosperity. Sometimes, when growth accelerates too quickly, it exposes weaknesses that were hidden beneath the surface. And this brings us to the central concern raised by critics of the plan: inflation. The warning signs. Could the economy overheat? Economists who are skeptical of the administration's strategy often describe it using a simple metaphor. They compare the economy to a powerful engine. An engine needs fuel to operate efficiently, but if too much fuel is injected into the engine too quickly, it can begin to overheat. In economic terms, overheating occurs when demand grows faster than the economy's ability to produce goods and services. When that imbalance appears, prices begin to rise, and that rise in prices is what we call inflation. From the perspective of critics, the concern is not simply that inflation could increase slightly. The concern is that the combination of aggressive tax cuts, deregulation, and potential pressure for lower interest rates could push demand much higher than the supply side of the economy can realistically handle. And according to several analysts, there are already signs that inflationary pressure has not completely disappeared. In December of 2025, the annual inflation rate was approximately 2.7%. By January of 2026, that figure had declined slightly to 2.4%. While that represents improvement compared to previous years, it is still above the Federal Reserve's long-term target of 2%. More importantly, inflation is not experienced evenly across all sectors. Certain categories, especially food, housing, and energy, can increase much faster than overall inflation. For many households, those are the expenses that matter most. When grocery bills rise sharply, families feel the impact immediately. When rent or mortgage payments increase, household budgets tighten quickly. This is why some economists worry that aggressive stimulus policies could reignite inflation just as the economy was beginning to stabilize. Another major factor in this debate involves tariffs. Tariffs are a key element of the America First trade strategy. They are designed to protect domestic industries by placing taxes on imported goods. However, tariffs often have unintended consequences. When companies importing foreign goods face higher costs, those costs are frequently passed on to consumers. Several studies have estimated that tariffs implemented in recent years increase costs for the average American household by around $1,000 annually. That means even while tax cuts might increase disposable income, higher prices for imported goods could offset part of that benefit. To better understand how this dynamic affects everyday families, Consider a typical household. Imagine a family of 4 living in a suburb outside Phoenix. One parent works in education, the other works in logistics. Over the past year, their wages have increased slightly, but each time they visit the grocery store, they notice prices creeping upward. Beef costs more, coffee costs more, fresh fruits and vegetables are noticeably more expensive. Energy bills fluctuate unpredictably. Clothing for their growing children feels significantly more expensive than it did just a few years ago. When they receive a tax refund from the new legislation, it certainly helps. But instead of feeling like a windfall, it often goes toward paying down credit card balances that accumulated during previous months of higher living costs. For families like this, economic growth statistics may feel distant from daily reality. Even if wages increase by 4%, if the cost of living rises by 6% or more, their financial situation actually deteriorates. And this is precisely the scenario critics fear. A headline economic boom that masks deeper financial pressure on ordinary households. Some economists even raise a more controversial possibility. They suggest that rapid nominal growth, which includes both real economic expansion and inflation, could gradually reduce the relative burden of the national debt. In simple terms, if the economy grows quickly and prices rise, the total debt of the country appears smaller relative to the size of the economy. But the downside of this process is significant. Inflation erodes the purchasing power of savings. Every dollar saved today buys less tomorrow. For retirees and households living on fixed incomes, that erosion can be particularly damaging. This is the darker timeline critics warn about, a brief period of economic excitement followed by persistent inflation and financial instability. But between the optimistic vision of explosive growth and the pessimistic scenario of runaway inflation, there is a third possibility, one that many financial analysts believe is actually the most realistic. And to understand that possibility, we need to look at how major financial institutions are forecasting the economy in 2026. The Republican coalition, a political alliance under pressure. Another important factor shaping the outcome of this economic gamble is the evolving structure of the Republican voter base itself. Over the past decade, the political coalition supporting the Republican Party has undergone significant transformation. Historically, the GOP drew strong support from traditional conservative voters, business communities, and older demographic groups. But during the Trump era, a new segment of voters began entering the Republican coalition. These voters include many working-class Americans, younger voters, and individuals who previously voted for Democrats but became attracted to Trump's economic nationalism and outsider political message. Some political analysts describe these groups as new entrants into the Republican coalition. And while this shift has expanded the party's base, it has also created new dynamics. Because these newer voters sometimes hold different economic priorities than traditional Republican voters. For example, many working-class voters who joined the Republican coalition support policies that protect domestic manufacturing jobs. At the same time, they can be more sensitive to rising costs of living, particularly when it comes to food prices, fuel costs, and housing expenses. If inflation rises sharply, these voters may feel the impact more directly than wealthier segments of the population. And because many of them joined the Republican coalition more recently, their political loyalty may not yet be fully cemented. Some surveys suggest that while traditional Republican voters show strong long-term loyalty to the party, newer voters are more likely to shift their support depending on economic conditions. In practical terms, this means the economic performance of the country over the next year could influence not only the midterm elections, but also the long-term stability of the Republican political coalition itself. If the economy expands strongly and wages rise meaningfully, the Republican Party could solidify support among these new voters for years to come. But if inflation accelerates or economic instability increases, some of these voters could become politically disillusioned. And this is why the stakes surrounding the economic outlook for 2026 are so significant, because the outcome will not only affect markets and policy debates, it could reshape the political landscape of the United States for the next decade. 3 possible economic timelines for 2026. When analysts attempt to forecast the future of the economy, they often build different scenarios based on how various forces might interact. No one can predict the future with absolute certainty. But by examining current trends and economic cycles, we can outline several possible paths that the economy could follow. And when I observe the broader economic momentum surrounding 2026, three distinct timelines seem to emerge. Each one reflects a different balance between growth, inflation, and policy decisions. Scenario 1, the economic boom. In the most optimistic timeline, the administration's policies succeed in unlocking a powerful new phase of economic expansion. Tax reductions increase consumer spending. Deregulation encourages businesses to invest aggressively. Interest rates stabilize or decline slightly, making borrowing easier for both companies and households. As a result, the economy accelerates rapidly. Economic growth could approach or even exceed 5% annually, creating one of the strongest expansion periods in decades. Job creation increases across multiple industries. Manufacturing investment rises. Stock markets respond positively as investors anticipate stronger corporate profits. Under these conditions, household wealth grows, retirement accounts expand, and consumer confidence strengthens. Politically, this outcome could significantly improve the Republican Party's chances in the 2026 midterm elections. A strong economy often benefits the party currently in power, and if voters feel financially optimistic, they may be more likely to support policies that continue that momentum. In this scenario, the administration's gamble would be remembered as a bold strategy that helped unleash a new period of American economic growth. Scenario 2, moderate growth. In the second timeline, which many financial analysts currently consider the most realistic, the economy continues growing, but at a more moderate pace. Tax cuts provide some stimulus. Businesses increase investment gradually. But structural limitations, such as labor shortages, supply chain constraints, and global economic conditions, prevent the economy from accelerating dramatically. Instead of 6% growth, the economy expands closer to 2% to 3% annually. Inflation remains somewhat elevated but manageable. Interest rates remain relatively stable. The economy avoids both extreme expansion and severe recession. For most households, economic conditions improve slowly but steadily. Wages rise gradually. Employment remains stable. However, the economy does not generate the kind of dramatic prosperity that political leaders sometimes promise. Politically, this outcome may produce mixed results. Voters may appreciate economic stability, but still desire policy changes. The midterm elections could follow historical patterns, with the party in power facing political headwinds. Scenario 3, economic overheating. The third timeline is the one critics fear most. In this scenario, aggressive fiscal stimulus pushes demand far beyond the economy's productive capacity. Prices begin rising rapidly. Inflation climbs above 4% or even 5%. As inflation accelerates, the Federal Reserve is forced to respond by raising interest rates sharply. Higher interest rates slow borrowing, reduce business investment, and weaken housing markets. Consumer spending declines as financial conditions tighten. Economic growth slows abruptly. In the worst case, the economy could enter a recession triggered by aggressive monetary tightening. This combination of slow growth and high inflation, sometimes referred to as stagflation, is one of the most difficult economic environments for policymakers to manage. Politically, such a scenario could create significant backlash against the party currently controlling the White House. Economic frustration often translates into political change. And historically, voters tend to hold leaders accountable for rising costs of living. As we look ahead toward 2026, it becomes clear that the United States is entering a period of economic uncertainty combined with significant opportunity. The policies currently being implemented represent one of the most ambitious economic strategies proposed in recent years. Supporters believe these policies could unlock a powerful new phase of growth and innovation. Critics warn they could destabilize the delicate balance between growth and inflation. The truth is that economic systems are incredibly complex. They are influenced by countless factors: government policy, consumer behavior, global trade dynamics, technological change, and the decisions of millions of individuals and businesses. Because of this complexity, no single prediction can fully capture the future. But one thing is certain: the coming year will be an important test for the American economy. The data released in the months ahead will reveal whether the country is entering a new period of expansion, maintaining its current trajectory, or encountering unexpected economic challenges. And those outcomes will not remain confined to economic charts. They will be felt in everyday life, in job opportunities, in the cost of living, in the stability of financial markets, and in the political decisions voters make as they head toward the 2026 elections. Economic stories like this continue to evolve as new data emerges. If you want to stay informed about major economic shifts, global financial trends, and the policies shaping the future of the United States, make sure to subscribe to the channel and turn on notifications. And if you're interested in exploring how past trade policies and economic decisions helped shape today's global markets, check out our next video where we break down the history of American tariffs and their impact on the world economy. Thanks for watching, and I'll see you in the next analysis.